Hey everyone, and welcome to this explainer. Today, we're demystifying the CD ratio, which is essentially the ultimate banking balancing act. We are literally pulling back the curtain on the very heart of the banking industry. If you're ever trying to read a balance sheet or figure out systemic banking risks, mastering this one single metric, it completely unlocks the entire machine for you. So let's get right into it.
Okay, let's dive into this with a quick hypothetical. Think about it. If your friends gave you their coins to hold and other friends wanted to borrow them, what would you do? Let's strip away all that confusing corporate jargon for a second and look at the raw mechanics using a super simplified model. Think of it like a neighborhood lemonade stand, right? One group comes along and gives you their cash just for safekeeping. But then another group desperately needs capital today and wants credit. So here's your dilemma. How on earth do you manage the inactive, sleepy capital sitting in your vault while keeping up with that constant, heavy demand for credit? Well, the answer is the fundamental engine of how a bank actually makes its money. It all comes down to a simple three-step cycle. Step 1, borrow cheap. You do this by taking in deposits. Step 2, lend dear, meaning you deploy those funds as advances or mortgages. And step 3, you keep the gap, otherwise known as the spread. Basically, you're charging your borrowers just a bit more than you're paying your depositors. Capturing that spread, that net interest margin, is literally the foundational secret to the entire global banking system.
And this brilliantly illustrates a critical shift in perspective. A 5-year-old at a lemonade stand sees this as just, borrowing from friends, lending to others, and keeping the extra. But a senior equity analyst, they look at this exact same thing as a complex spread business. To an analyst, a bank's balance sheet is famously inverted. Now, what does that mean? It means the cash depositors give you, the deposits, are actually your liabilities, and the loans you issue are your income-generating assets. It's kind of wild to think about it that way, right? But since those loans are the assets generating all those juicy, higher yields, it begs a pretty huge, pivotal question. Why not just lend out every single penny? Seriously, why not convert 100% of those deposits into high-yield credit to totally maximize your returns? It sounds incredibly tempting, doesn't it? Well, this is exactly where the ruthless dilemma of risk versus reward kicks in. To navigate that tricky dilemma, the banking industry relies on one vital metric: the CD ratio, or credit deposit ratio. The math is super straightforward. It's simply total advances divided by total deposits. But don't let the simple math fool you. This single figure is the absolute ultimate gauge of how aggressively a bank is pushing its money out the door. It tells us the exact proportion of that deposit base that has actually been converted into credit. So, let's re-anchor this abstract formula back to our dual lens framework. At the lemonade stand, you're just asking, hey, how much of that held money did you turn into lemonade on credit? But for an analyst, this metric is a high-stakes tug of war. On one side, you're looking at balance sheet efficiency, basically measuring how hard the bank's money is working for it. On the other side, though, you have funding pressure. It acts as a real-time stress test showing just how dangerously stretched the institution's liquidity might be getting at any given moment. Let's move to and see how this builds into what we like to call the Goldilocks framework of banking. See, managing the CD ratio isn't about pushing it to the absolute maximum limit, and it's definitely not about just hoarding cash in a vault. It's a constant, tricky search for that just right temperature. It's all about navigating the fine line between capital that is way too lazy and funding that is running dangerously hot. Let's break down those two extremes. Say you have a low CD ratio. That means you're in the cold zone. Your capital is lazy. It's just sitting there idle instead of generating any real yield. You aren't operating efficiently at all. But push that ratio too high, and boom, you enter the hot zone. Sure, you're working the money hard, but you're incredibly vulnerable. You're stretched, you're competing aggressively for deposits. If some sort of macroeconomic panic sets in and your depositors suddenly want their cash back all at once, a stretched bank simply lacks the spare coins, the liquidity, to survive without scrambling for incredibly expensive emergency funding. So the crucial point is figuring out where that exact boundary actually lies. In the banking industry, the magic threshold usually sits right around that 85% mark. When a bank's CD ratio crosses into the mid-80s, let me tell you, alarm bells start ringing loudly for analysts and regulators alike. The diagnosis immediately shifts from, oh, they're efficiently deploying capital, to, wow, they are dangerously stretched. The bank's funding engine is maxing out. Now, what's really interesting about this slide is the crisp takeaway that summarizes this entire balancing act. As the quote says, CD ratio is how much of deposits a bank has lent out. Too low is lazy, too high is stretched. That one line right there, it perfectly captures the constant everyday tension banks face between trying to maximize their profit and making sure they can actually survive a sudden liquidity crunch. Which leaves us with this. If you see a bank constantly pushing its CD ratio past that 85% threshold, you really have to ask yourself, what hidden risks are they taking just to keep their engine running? Are they quietly scrambling behind the scenes for really expensive deposits? And honestly, more importantly, are they actually prepared for a liquidity shock? So the next time you're looking at a bank's earnings, do yourself a favor. Look past those flashy profit margins and go check the CD ratio. See for yourself if their capital is just being lazy or if their engine is stretched to the breaking point. Thanks so much for joining me for this explainer. I'll catch you next time.